Good morning, ladies and gentlemen. Sorry about that. It happens. So, welcome to the FOMC stream. I should say, man, it's been a hectic week. It's been a rough week. It's been, yeah, it's been a week and a half for me in terms of trading. I've taken losses after losses when I try to swing. Yeah, man. It's one of those days, man. Where you taking losses? And it's not nice. When you take losses like I am right now, it's really, really, really worrying. Um, so let's get into it, man. Let me stop complaining. I've taken a loss AUD CAD. I've taken a loss USD CAD. I just wanted a continuation lower, but we recovered. I've taken another loss USD CAD, USD CHF. I didn't take any trade. Another trade that I've taken a loss is Bitcoin. I've taken a loss on Bitcoin as well. So yeah, it's been rough. But let's get going, man. What do you think? I have just 10 minutes to mumble before FOMC breaking news and before we start setting up for FOMC. But for now, it's been rough, man. Okay, let's get into it. Um, yeah, for now, I think the only pair that I'm looking into and I have a limit on. Mm-mm. Oh God, yeah, I'm tired. It's NZD CHF. I am looking for that support to hold to look for continuation to the upside. So my limit is set already. Just missed me by a few pips there, but it's rough, guys. It is rough. Yeah, I think I've taken enough losses, but let's get going, man. So I have a limit here, buy limit, and I'll also explain the fundamentals behind it. And then moving forward, also, I think yeah, those are the only one that I'm looking for a trade on NZD I'm looking for longs. I'm hoping we get triggered. Also there is what is this? Hey man, where's my brain? Come back. I also have a trade NZDCHF. I mean gold. Sorry, I'm being disturbed by football, man. Sorry about that. So we have a potential longs again on. Why did I get an energy drink? I'm tired. And I'm not a coffee person. Oh God. Oh, I need water. Let me get water. So I am looking for continuation to hold that support, to just get a continuation to the upside on gold. I do have a position, but gold I bought GLD. I bought GLD. I bought GLD on gold. Yeah. So I have a trade on GLD. I just bought gold ETF. Oh God, what's happening? Gold GDL. I bought an ETF for gold. So I decided to go for that. But other than that, man, stocks. I mean indices, sorry. Uh, come on, slow. Another day, another doula. Indices, we are still quickly rushing towards, we are really truly trashing towards the all-time high. We look at that continuation to the upside, going for this all-time high. With FOMC coming in today, we are likely that if we get rate cuts as a surprise today, If we get rate cuts as a surprise today, we might see indices coming back, taking out this all-time high and closing on the all-time high. Okay, closing at the all-time high. Sorry, guys, I'm just being distracted by football. I love football. But anyway, so this is what indices we're holding, and we are likely to get rate cuts this quarter. It might not even be today, but there is possibilities of getting rate cuts in this quarter. We've seen Russell pushing to the upside. This was a trade that I had, but I closed it off. Dow Jones is still failing to break above this 200 MA. So if it breaks above, reaches the 200 MA, perhaps a move to the upside would make sense. But for now, I'm just gonna wait outside 5 minutes before FOMC. 5 minutes before FOMC. Um, so what do? We prep for FOMC. We prep for FOMC. Let's prep for FOMC on in terms of day trading, man. I don't have much to say today. It's been a rough week. So, 3 minutes before FOMC, let's quickly do a day trading analysis. Just quick question. Do you want us to listen to Powell, the speech, and decide what he is saying and how can we interpret it? So we've taken previous daily, come on. We have taken previous daily high and we look like there is a strong continuation to the upside. So yeah, I've taken yesterday previous daily low, high and low. Very strong bullishness coming through. And trust me, if we get rate cuts, we are likely gonna get a good move to the upside today. If we get that such a surprise, we are likely gonna get that. Okay. Uh, hmm. We have a 1 hour fair value gap here. When you look this way, there is a breaker. Just gonna quickly do this. There is a 1 hour fair value gap with a possible breaker. Perhaps, yeah, 1 hour fair value gap, yeah. So if during FOMC we have the first reaction will be coming in here and then we start looking something like that, I will look for long. I think so. Because that fair value gap, it has a breaker, it can hold, it can strongly hold and we look for continuation to the upside. But also if Nasdaq S&P 500 come back, take out that low, react there, and then that will be nicer as well. To give an SMT, that will be more nice. I will appreciate that. I don't even know if I'm audible. Okay, 2 minutes before FOMC. Let's get preparing for FOMC. Okay. So my idea right now, it's a move like this. Okay, it's a move like that, but let's go for FOMC in a few minutes. Oh, come on. Okay, FOMC coming through. Breaking news. Let's see interest rate decision. Okay, it is here. Let's see the first reaction in the market. What happens when they announce the decision? Let's see. Let's see the market reaction. Okay. This is Nasdaq. Let's see how will it react to the news. First reaction lower. Okay, we push to the upside. That's the first reaction. We might have gotten red cards. Let's see. And I will speak through what happens now. Come on. Okay, we got the same. They kept the interest rate the same. Now we're gonna hear from Powell what he says. So now we're gonna go for the projections and hear what he says. The first reaction is to the upside, because if we don't get rate cuts, therefore that means we are keeping the interest rate the same anyway. That still uh, gives an idea of and already we're already priced for the for keeping the interest rate the same. So in this instance, we are likely the market is saying if it continues breaking above and continues higher, it's just directly saying that we are already starting to price in rate cuts, because if we're keeping the interest rate the same in this meeting, for the next meeting we are likely gonna get rate cuts. For the next meeting or within this quarter, we are likely gonna get rate cuts. But for now, we have kept the interest rate the same. We are still moving to risk on assets. So I think that's why we got such a move. And unfortunately, let's look at the dollar. Yep. Look at what the dollar is doing. The reaction was low. I just took out that low, and coming back, we're starting to see another rejection again. So what's gonna happen right now? And this is purely my projection. The dollar might still to continue getting a hitting here. The dollar will continue getting a beating, even though we didn't get rate cuts, but we are starting to price in for rate cuts for the coming quarter. In this quarter, I think that's my projection. Yes, I've taken this loss. I've taken 3 losses or 4 losses this week. It's been terrible. So yeah, I am thinking maybe we're gonna start to see another rollover. Perhaps I will look to re-enter and to start again looking for lower prices given the reaction here, reaction on that fair value gap. So if we break below, give a market structure shift on a retest, I will look for position to continue going short. So that's another possibility that I'm looking for. I am still bearish for the dollar because I'm still predicting that there might be a rate card this year. Let's see on the position. I just have taken a loss. What the market is saying, nothing much. So yeah, man. We've taken another loss. It's been horrible. I should say it's been horrible. It's been a horrible week. Oh God, I have to prepare Monday. Oh God, I'm tired, man. It's been a horrible week. But what do you think, man? As you jump through, don't forget to like and subscribe. So it's been a horrible week. So we'll get, oh God, we will get into it. So we have seen that the rejection, the dollar has gained a lot of strength. Like I think they've already priced in. The reason that we don't see huge market move, there was no surprise. Remember, the market works on surprises. So if there's no surprise, the interest rate has been kept the same. It means Already, whatever is happening in the market is been priced in already. So there's nothing interesting. There's no surprise in there. So that is why. But just prepare to see what Powell says. Perhaps we will get a decisions and what we want to do. You could look for shorts to come back here, to be honest, before Powell says something. Let's see. But it'll be very aggressive, eh? Because if you enter now, this market structure shift here. Yeah, that's a market structure shift. Hmm, okay. The market has already reacted in a space where I wanted to look for shorts, man. Let's see. The market's gone, man. I am looking for shorts, to be fair. Yeah. We rejected at this breaker. So the rejection at that breaker, yeah, exited the breaker, we're starting to roll over. We should be coming in to take out the low. But the big boss is talking in a few. So I will decide what I want to do with going into FOMC. So let's prep for FOMC. Let's see if we're gonna get a retest. Already we have gotten the retest, but let's see if we're gonna get another retest before Powell says something. I have a headache. I think I need to take medication. So, but anyway, do not forget to like the live, guys, and tell me what you think. Okay, I'm preparing for Powell. Don't be surprised. Oh, should I take this trade though? I'm contemplating a trade, so if I'm on my phone, just know that I am thinking of taking a trade. Oh, I'm just quickly preparing for Powell. I have my limit on. Let me just quickly open here. I have my limit on. Let's see. Um, yeah. I just went in very light. I was not too aggressive. I have not entered, but I do have a limit. While preparing for the boss, let's see what's gonna happen. To be honest with you, I will be more lying towards the bullish. So what I'm trying to do is to get a rejection there, roll over, come back to this 1 hour fair value gap. Maybe during his speech, we might get a reaction like that. Okay, I'm on the trade now. Yeah, I'm on a trade. Okay, good move so far. Okay, let's prepare for power, man. What do you think, guys? Don't forget to like and subscribe and tell me what you think. And when the market is very versatile, uh, I'm that guy who honestly prefer, who moves uh, my stop loss to break even quite fast because the market is a bit versatile. I don't expect it to reverse back. So I'm just gonna wait for the few minutes to see what's gonna happen. But as we're preparing for FOMC, okay, it's not speaking yet. Okay, he has not started speaking. Let's see what the market is telling us, man. But what do you guys think? What do you guys think? I'm on the trade. Just quickly do this. What do you think? If this 1 minute closes like this, I'm gonna move my stop loss to break even. On a day like this, I'm not too aggressive, man. Okay. Didn't close bearish the way I wanted. Yeah, didn't close the way I wanted. I wanted to close bearish. Okay. Quickly setting up for the man, man. It looks like we're getting a reversal. I'm gonna test the quality of the voice. I've just changed this, so I don't know if the setting have changed. Just pardon me. Okay. So the quality is good. We are just gonna wait for Powell to come through. I know when it comes, a lot can happen with my trade right now. I just wanted to be break even by the time it comes through. But yeah, we're still waiting, man. Do you guys want me to speak just to interpret the FOMC? But let's do it at the end, man. Let's do it at the end. Let's do it at the end. Good reaction so far. Let's see if yeah, good. Okay. Come on, man. The man will come through and everything will be a disaster. Doo-doo-doo. So I don't like what's happening here. Moving to break even will be also something that is too early. So please don't forget to like and subscribe and tell me what you think and your bias for the FOMC. Let's create a poll. What's your bias for the FOMC? Okay. We don't seem to be distributing lower, man. Because I'm certain whatever is gonna say at the beginning, we are likely going to get something like this. But my idea was to get to this. There is a 15 minutes fair value gap here, and then we can start pushing back to the upside. Hence, I took this trade. But let me hold on to it. Um, what's your bias, man, for the FOMC? Guys, I'm so thirsty. Back to the break-even point. Okay, I'm just preparing a poll. Guys, tell me what's your bias, man. And what do you think the market will do? It looks like we're setting up for bulls here. What's your bias, man? Back at break even again. Yeah, the market is not marketing for me now. For me, I am short for longs, man. I don't know if it makes sense. I'm short for long. Oh, come on. So as you're coming through, tell me what you think. Do not forget to like and subscribe. I'll truly appreciate if you guys can like and subscribe. And just come in on the comments, man. Tell me what you think. And let's just do a quickly check in. Whoever is watching, where are you from? And where are you? Where are you from and where are you? And as you take the poll, you'll tell me. No, I'm thirsty. I think I'm thirsty. And I have a headache, so I will go take my the, I will go take my painkillers, man. Okay, let's see what's happening. Is he coming through? No, he's not in yet. Okay. This is the day that the Lord has made. As I'm thirsty. And this market does not want to distribute. What's your bias, man? Preparing for water. Need to go get water before the man starts speaking. Good move. I think the next 1 minute candle is very important. If it leaves a fair value gap here, I will be break even. I'm just gonna see. I will be break even. Okay, last 30 seconds. Let's see. So I'm also just checking if Powell is coming through already. Because I wanna get water before he comes back. 1 minute before closure. I mean 30 seconds, we're starting to get this ball. We're not leaving a fair value gap here. Terrible. Terrible price action. Okay. We are about to close the 1 minute. Okay, we've closed. There's left a fair value gap, a 1 minute fair value gap. And as I said, with this 1 minute fair value gap, I'm gonna move to break even. I am moving break even before power. Or just I've decided to put my stop loss here. I've just decided to put my stop loss here. So my stop loss is here now. I just didn't want it to be too tight. Let's see what's gonna happen. Um, I've reduced almost the entire risk that I had on the market. So let me just quickly get water. I need come on. I'm gonna use this. Okay, I am gonna. Okay, moving my stop loss to break even. Okay, stop loss at break even. Okay, stop loss at break even, ladies and gentlemen. I don't even know if I'm muted. Yeah. Oh God, I'm fooled. Stop loss at break even. Okay, whatever. Let's see if we're gonna get a total reversal. Let me see. Is a main here? Okay, still nothing. Let's quickly prepare. Stop loss at break even. I'm about to. Oh, I'm out on break even. Okay, I'm out on break even, and I don't mind. What's happening? Why is there no sound? Oh, I see. Okay, I'm out at break even. Yeah, I'm out at break even, man. Look at that rejection back. So I would have loved to see a continuation. So I am fine with. Oh, I am fine with a break even. So 1% has voted either bearish. Please, guys, do not forget to like and subscribe. Come on. I am out on break even. So let's wait for our ideal position. Um, okay. First trade today, break even. And there is still a lot of possibilities to still continue coming lower. But I just don't. FOMC, it's somehow, man. Sometimes I have to reserve capital. So still, the original plan still stands. I am not gonna jump in on the trade because there is also this 1 minute fair value gap here. So the market will be coming back up again to come back, take the high. So yeah, uh, original plan still stands. Though. We don't change the original plan. We are at a 5 minute fair value gap here. Invasion 5 minute fair value gap. That is why perhaps it could be rejected. So let's just watch and see, man. Since I'm out on the trade, oh god, I'm hot. Let's see what's happening. Come on, Paul. Give me a trade. So tell me, guys, do you want me to talk about what I think while waiting for power? Yeah, the market is not decisive. I think I did well by going out because even if my stop loss was here, we are likely gonna see something like that. So I think I'm happy with my decision to take a break even. Very happy. What's your bias, guys? So please don't forget to like and subscribe. and share the life, man. We trade the FOMC. And as I said, there is a lot happening while waiting for the FOMC. Oh, shucks, there is something that I've been willing to check, eh? I've been I've been wanting to buy SA Top 40 ETF. I don't know why I've not been buying it. Oh God. Okay, he's here.
And
Copy and
stable
paste as
prices
always.
for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment
Okay,
and
we are
tangibles
still
rebounded
holding
from weakness in the fourth
the
quarter.
1 minute fair value gap. We don't seem to be
Surveys of
aggressive to the
households and
any
businesses,
side. Let's
however,
see what he
reported a
says.
decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low.
So right now, just taken out where my stop loss was B, we look to be bullish already. We have that 1 minute fair value gap.
Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March.
Oh, interesting.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary
We're still pushing higher, but let's wait and see.
maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Didn't say much besides like it's a copy.
Thank you, Colby.
So far, he didn't say much. It seems like a copy and paste of the previous meetings where he just sells the same thing. So let's see from the questioning what we'll get from it if he's more lying towards rate cuts in the next this quarter.
We've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more, and we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that
Interesting question.
inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Not getting much from this guy.
Thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up.
The new Le Parfum is deep, sexy, and
sorry about
follows
that.
you all night long.
There's a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time, and what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the war will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem.
There's no SMT. Perhaps if there was SMT between Nasdaq and S&P 500, if one of them taken out that, I was gonna maybe look for shorts to this low, but that didn't happen. He's not saying anything aggressive. He's very neutral for me. So, yeah.
They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though.
The reason why I'm not even going to attempt shorts, I don't see any SMT around here. Perhaps if there was an SMT, I will look for shorts, to be honest. S&P 500 failed to take out this high. So if it has taken that high, it gives an SMT, perhaps. It do make sense if it has taken that to go short. But for now, I'm fine at breaking. I'm fine at not taking a trade. Remember, I still want to see this low taken to 15th favorite gap. So I'm just gonna watch.
Strength and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Economic solid. Yeah, it's going without me.
Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or
Beautiful question from this guy.
a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at...
From what he said, I'm picking up that there is also a possibility for not getting rate cuts unless we start getting more stable inflation data, good employment data. Other than that, he's a bit neutral. That's what I'm picking out from him. He's a bit neutral. We might not get rate cuts, so we should be just looking along those lines. But this is more long term. For now, the reason why I didn't take this fair value gap here is purely because we didn't take out this. I would have loved if Nasdaq or US30 has taken out that high, we will have an SMT. Perhaps I would have considered taking this short here. Right now, you could look for consolidation, but I would love for me to take out this, come back to this 1 hour fair value cam, then maybe we can look to go long. The reason why we are getting this consolidating, not aggressive move is it's very neutral, lying more towards saying we might not get rate cuts. Perhaps the market was already priced for that. Was not priced for that, but not rate cuts, anything can happen. Rather than giving us a very bullish sentiment or bearish one, he's just too neutral. He's not saying much, but he's more like saying we're gonna get we might not get we might not get rate cut this quarter.
In a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So
we have gotten to
more
our
is not
target.
necessarily better, but better is better. So we're going to be looking.
We've gotten on our target. I could have jumped off earlier on, remember? Earlier on, I was on this trade, and I'll explain why we are selling off. So this was a move I was looking for. But however, I decided to break even because I was not getting the distribution that what I wanted. So I took break even. Now, with what happened now, I couldn't take this because we didn't take it as high. So it didn't meet what I wanted to. So I wanted to take that high. And then S&P 500 or Nasdaq fails, we have an SMT. I was going to take these shorts here to come back here, and then I did explain. But now we're already reacting here. Now we are reacting where I always wanted a possible trade to go longs. We are inside. We have taken that low. So I think I am more comfortable to start looking for shorts. I will start to look for shorts now. For longs, I mean. I'm starting to be bullish. Yeah. I am watching this fair value gap here. If we get something like that eventually, per- perhaps I'll look for longs. But now let's just wait.
Decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean,
Question.
Monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad. right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. I'm Aaron Moakley with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to...
So he seems to say that though the rates are coming down, but tariffs, he's still worried about the tariffs. So he's not going to cut immediately because other things, like other inflation data, it seems to be coming down. His problem is tariffs. And to put tariffs exactly, how will it affect the economy? It's very tough. And in that sense, they will still keep the interest rate the same for now. That will be very, even for this quarter. So perhaps that is why Bitcoin, Nasdaq came
Are
down.
careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the
I'm going to look for longs here. I don't know what happened, but I'm going to look for longs for now. I just bought here. It's not looking good though, but I like it. Yeah.
Over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Okay, on my long position, as I said,
Thanks, Chair Powell.
very
Neil Earl with
neutral
Axios.
guy. It's not
There have been
giving
some
us anything.
cutbacks
That's
in
why there's no
economic
huge
statistics
moves.
collection in the last few weeks.
Please do not
Worries that
forget to like
long-running
and
problems
subscribe.
around funding and response rates may be getting worse. How much is this concern on
Do not forget to like and subscribe, guys.
you're watching to assess the economy are reliable right now?
You know, two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But that's not going to be up to me to decide.
Is that affecting at all
No.
Have you been sitting on a smart business idea and need to get it online?
But that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but it tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is, and it's just a different thing. So I think this is something that certainly has transformational potential, and probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive, and there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Is it done?
Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movements of the dollar was impacting the economy. Are we going through something like that now? That are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint. You see this not just here, but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. But it doesn't change our objectives or what we need to do. And, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's a an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with M&I Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime,
we're not getting rate hikes.
We do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
Okay, he's done. So what have I picked up from here? I'll tell you now. Okay, let's talk about it. What have I picked up from here? His last message was, we've closed above the fair value gap. I'm gonna move my stop loss to break even, and then we can start talking. Okay, don't forget to like and subscribe. So 5 votes, interesting. 60% say bullish, bearish, 40% say bearish. So what am I picking up from what Powell, the big boss, is saying? So his last in this entire thing, and I think the last message he said was very important for me. Sorry, break even. His last message was very important for me when he said possibilities of rate hikes are extremely low. This is very important because when he says possibility for rate hikes are extremely low, the only thing we could get this year, and we're not saying that's the only thing, but the only thing that we could get this year is rate cuts, or keeping interest rate the same. So I love that he still says rate hikes are not a solution. However, possibility when we have stable jobs, if the jobs are stable, we still start to get more clarity, more certainty in the market, and we start to get what's this in English? Certainty in terms of tariffs, because tariffs are a problem to them, because basically tariffs in this is they can't put a finger on it. You can't determine how inflationary they are. So therefore, when you look at the consumer spending, you look at your retail sales, and I've spoken about this before. You look at your retail sales. When you look at retail sales says we are slowing down in terms of inflation. However, what he emphasized a lot was tariffs are a bit of a distraction to them because they can't really determine where to next. So basically, that's what Powell said, and his conclusion was rate hikes are not a solution, but rate cuts possible. So as I said, that will be very bullish for Nasdaq. Rate cuts are good for Nasdaq. For sure, Russell has given us a higher move to the upside. So I think my trade on break even is good. I'm on break even. And do not forget to like and subscribe. I would truly appreciate if you do that, guys. Let's get to 100 subscribers. So 5 people have voted. 60% says bearish. And 40% say bullish. Interesting. I've taken the first trade I took was a break even, and even this trade now it's still break even. Let's see if we're gonna get to hit take profit. Let's see. But how has been the FOMC for you guys so far? Traded break even. I want that 1 minute fair value gap to hold, to be honest. If it holds, for sure. Okay, 5 minutes before the bottom of the hour, 9:30 South African time. And already, ooh, look at that. This is a problem. Look, for day trading, man, I am bullish. Long term, I'm bearish. I don't know if I've answered your question. US30 S&P 500, I am bullish. So now we have a problem. We are reacting at a 5 minute fair value gap with a breaker. We are likely to still gonna go short. Nah, I don't think my trade will hold. Yeah, we reacted exactly at a premium price. Now we are rejecting all the way down. I could be taken out on break even. Yeah, 2 break-evens in a day will be very painful. But let's look at US30 according to Ruhan. US30 has taken that. US30 had a lot of consolidation. Look at those consolidation. I will have hope for a continuation to the upside, but we are failing. Also, there is more consolidation. So US30, if it were to close above like that, a good move to the upside was gonna be very beautiful. But I might be taken out on break even. For sure, I'm out already. Yeah. Okay, break even trade. Look, I will explain why this trade's a break even. Aldo, keep it up, sir. Thank you, man. So 2 break-evens for the day, very annoying. But let's get into it, man. Why this trade didn't work out? Let's just quickly do a trade recap. Remember what I said? I said I was looking for the market to take out this low, give us a low and push back to the upside. After it has taken there is a previous daily low here. And after it has taken the previous daily low, I want to see a continuation to the upside. And that small move did happen, give us a 0.5 already. We're looking for a continuation. But my worry, the reason why I moved to break even, and this will apply overall between Nasdaq, S&P 500, and US30. Because, yeah, break even day, annoying, man. So it's already 3 break events for the past 2 days. So I went long, moved to break even. We are reacting. Look at that. We are reacting at the 5 minutes fair value gap with a breakup block. So if this 5 minutes will have managed to give us an invasion of this breakup block, we were gonna get a continuation, but it didn't do that. And I thought it's best for me to move to break even. And I moved to break even. Look at that failure. And there is also a 3-minute breaker. So it is a very, very interesting space. Yeah, we took a break even, man. And if we to look at the 1-minute time frame, we saw a good distribution from entry. Higher came back for this 1-minute fair value gap retest. We broke above, but it was still failing to distribute higher. And then from there, we just went lower. So I think that's what happened. Do not forget to like and subscribe, guys. Please subscribe. I will really appreciate you guys if you subscribe and share. Roman, Kula, I hope I've answered your question. Aldo, thank you so much. I'll keep it up, brother. I will try. So 7 people took the, what do you call this? The poll, and 71% says they're bearish, and only 29% are like me, are bullish. So far, the market is failing. Ooh, so look, I am bullish, but if you were bearish, here is a trade, man. Here is a trade. I'm not gonna take it. I've taken 2 break evens already. But here is a trade, brother. And this is purely because of the reaction on this 5 minutes fair value gap here. No. Reaction on this 5 minutes fair value gap. Okay, let's see. I wanna see something, man. Do we have an SMT? No, we don't. S&P 500. Thank you, brother. We still don't have an SMT. Look, there is a breaker. Shorts are a possible thing to do, but I'm not going to take shorts. I've convinced myself that I'm bullish. I'm not even going to attempt to take shorts. Let me quickly shut down this. I am not even going to attempt to take shots. But if you were bearish, this is a move for you, man. Something like this will make a lot of sense. We held a 5 minutes fair value gap, came back all the way to my entry and leaving this breakup block with a 1-minute fair value gap. It's not an A plus setup, but for those that said they are bearish, this will be a move for you, but not something that I would be looking for or not something that I'm interested in. Understood? Makes sense? So this will be a good move for the bears. Not for me. I'm not a bear, man. I'm a bull. So I'm with people that have just taken break even. Let me see US30. FMC. Okay, we have created lower lows here. Interesting. Bulls can be coming through again. Look at that. We've created lower lows here. Yeah. I'm still bullish, gentlemen. For those that have taken these shots, yeah, it's good for you. Leave a comment, man. What do you think? Do you think are we still gonna get the bulls? Though it's towards market closure, so I might even call it a day. So we have an SMT here. So if we break structure here, we could look to continue long. And I think the next target for me will be the next target for me will be this high here. Yeah. Oh shucks, the market is setting up for me. Let's see. No, it's not. I'm gonna give it until quarter two. If doesn't flip this again, I'm gonna call it a day. 2 break evens. I'm not complaining, man. What is S&P 500 doing? Guys, please subscribe and like the live. I'll truly appreciate it. It will be really appreciated. Okay, no was not taken. What's happening here? Is there something that I'm missing? Okay, that will be a very good trade though. Oh, between the, okay. Hmm. Invasion, yeah. Look for continuation, 1:2. Something like this, but this is not something that I normally trade. I don't like taking invasions like this, but this will be a very good invasion. Held inside a control area, inside a consolidation, we created a lower low. S&P 500 failed to create a lower low. Get an invasion fair value gap, look for an entry. Your first target will be this high. That will be very beautiful, but not for me. So I am gonna look for a continuation here. Let me see if we can break structure here. But that would be dependent on the 5 minutes time frame. To be honest, let's see. Just gonna remove that. So yeah, man. Please don't forget to like and subscribe. Let's get to 100,000 subscribers, guys. I will truly appreciate that. I hope all of you liked and subscribed. And thank you so much, guys. Okay, I'm not getting a continuation to the upside. Yeah, we got an invasion, yeah. We did get an invasion of this breakup block. And people that really trade invasions, they could look for a trade, something like this. But hey, man, not for me. This for me, it's a bit risky, and I don't like taking trades like this. I don't see structure for that. So yeah, man, I will do the morning at the end. Okay, 7 people took the poll. 71% said they are bearish, 29% said they are bullish. That was interesting. Yeah. 5 minutes. 7 minutes before quarter two. So if nothing changes, I am gonna call it a night. Yeah, this is a very important high here. Come back for this size. Yeah, I'm looking to come back to this highs here. But we don't seem to be distributing the way I want. Let me see this one. You see? Broke up below. Others are short to come back to this low as there is support, but there is the strong support this side. So you are at a dire situation, ladies and gentlemen. when things are like this, you just have to accept defeat and say, I'm defeated. Longs are set, man. But I'm looking at the time as well, so there don't seem to be more momentum. This is the last 5 minutes. If I don't get a good distribution, then I'm gonna call it a night. Yeah, I'm gonna call it a night, man. Come on, the last 4 minutes of the show. Let's say if we get good distribution, then we are set for longs. Come on. 3 minutes before 5 minutes closure. Yeah, it's not happening. Okay, 3 minutes before closure. Okay, it's not happening. I'm gonna call it a night, man. Okay, guys, I think we're not gonna get what we wanted. 2 minutes before, maybe this will be a very critical 2 minutes. Okay, good moves so far. It is happening, Kula. It is happening. I'm hoping it will happen, man. Let me remove this. It is happening. Uh, top of the hour, 10 o'clock. I don't like it normally. Kula, just a quick question. Where are you from, brother? Okay. Where are you from? Got nothing has happened. And okay, let me start with my closing remarks from where in SA, if you don't mind me asking. Where in SA, brother? So, let me give you my closing remarks. It will be in two folds. Okay. So, ladies and gentlemen, we had FOMC today. Powell purely said he will use data to determine the direction as always. It was a copy and paste from the previous FOMC and interest rate decisions. But what I personally took from that is inflation is a bit stable. Possibility of rate cuts are there. However, the problem is tariffs, where he's indecisive of, or you can't put exactly how to really score it in terms of how it contributes towards inflation. But when you look at consumer spending and other things, definitely inflation has come back lower. And someone asked about oil prices. And then with the oil prices, he purely said the war with tariffs, you can't determine basically the war because there's a war between Israel and Iran. Iran is, we all know that Iran is responsible for the world oil distribution, is one of those countries with a huge amount of oil. So with that, oh, this trade is looking good, eh? For those that took that trade, it's looking good. Whoever took this trade, you are said, brother. If I was you, just that I don't trade this kind of setups, but if I was you, I would be break even. Not far from the first take profit. But anyway, let's get into it. So, uh, and then he can really decide where they can't really control oil prices. And I think it's fair for me to say, with oil prices, we all know with oil prices, higher oil prices are very inflationary. That's one of the things that perhaps he is worried about. Higher oil prices, very inflationary. Remember, if oil becomes more expensive to buy, distribution of goods, basically logistics becomes expensive. If logistics is expensive, that becomes inflationary because someone has to pay for those for the increase in oil prices, for the increase in tariffs. I think that's what he really emphasized on. And one important question that I picked and that I love from one of the journalists was, will uh, what was regards to saying, are we going to get rate cuts or not, or rate hikes? And there's something that he said that was very important for me. He said, rate hikes are not a possibility. Rate hikes are not a possibility, but we should all note that when he said rate hikes are not a possibility, literally what he is saying, it's saying that rate hikes can happen, but with lower inflation like we are seeing right now, the problem is the oil prices, the problem could be tariffs, but rate hikes right now are not a possibility looking at the jobs data. And the projections for the jobs data, it's about 4.5%, which is not good. So far, we're at 4.2. It is stable, but we are likely going to get higher unemployment rate in the US. And he spoke about people are not losing a lot of jobs, but if you lose job, it is very tough to get another job. So that's one thing that he also emphasized on. But my biggest pickup is rate hikes are not a possibility. So we are gonna get the same interest rate or rate cuts for the year, and that's very good. So I think that what I picked up from it. And then in terms of uh, my trade, my trade, what do you call it? Remind me now. My trade, you know that I'm on a lot about my trades. Trade recap. So before Powell came in, I was looking for shorts within that 1 minute breaker, looking for shorts to come back to this inside, to come back to take out this low, come back to this one here. This gray box, it's a 1 hour break, fair value gap with a breaker on the other side. So my idea was to take out this low, come back inside, start to reject back to the upside. So that was me, and that was definitely what I was looking for. Did it happen? 100%. So the first trade that I took, we saw a market structure shift as I marked. We rolled over. I took shorts there. Stop loss was above this red candle there, and my target was this low. Did the market do exactly that? Yes, the market did exactly that. And however, because Powell was not coming, before Powell comes, you never know where the market is going and the aggression in the market. So I entered the trade. We saw a lot of consolidating, but when we saw this distributing, leaving this tiny fair value gap here, I was like, let me move my stop loss to break even. And Powell was about to come through. So you really don't know what's going to happen. While I was in this trade, I moved to break even. And when Powell started creating, we saw that move. Power starts creating, we run over to the upside. And I was still looking for shorts, honestly. I was still looking for shorts. But the fact that I took a break even I loved how I managed my risk. I love how I look at the situations and looking at other data to say, he will be speaking about that he might be very bullish towards indices, given that we might not get rate hikes, we are likely to get rate cuts. That would be very bullish for indices in this instance. So that's an idea that I was looking for. Hence, I was like, let me move to break even. So we roll over. I love how I manage my risk. But anyway, long story short, I took a break even earlier on. Power starts speaking, so we saw those moves. But my idea to say, if I want to get another short trade, my idea was if I want to get another short trade, as I was bearish until I take out this low to look for longs. I wanted to see an SMT between between Nasdaq US30 or S&P 500 here. However, all of these three indices failed to take out this high. So that for me was like, it doesn't give me confidence to look for shorts because I don't have SMT in the lower time frame. Remember, today was a very volatile day. You don't know what Powell would say, will be hawkish or dovish. I really do not know what he was gonna say. So my idea of taking a pre-given was best, and for me to wait directly for an SMT to see one of them taking out the high and the other failed to take out the high, I was gonna look for shorts. With that, I lost this beautiful trade that I lost here because my stop loss was still intact. But possibility of my stop loss being hit were still there. So that's what I'm saying. I do love how I manage my trade. But moving along, so the next trade that I was looking for, it was this fair value gap here. Remember, if here I did get an SMT, let's say Nasdaq fails to take out this high, the other one did create a high, that's an SMT. I was gonna take this short here, stop loss perhaps above there, or if you wanna be safe above there to roll over, come back to my original target when we started the stream. Unfortunately, because didn't meet all my requirements, I didn't take a trade. And then the last trade that I took, and it was a break even again today. I'll still be in this trade to be fair, but is it worth it, man? I don't think it was worth me on this trade. Anyway, so coming back, we've already reacted on the 50 minutes fair value gap. Remember this liquidity strip that I wrote, and we're inside the 1 hour fair value gap, and it's a bullish fair value gap. And I marked this 1 minute fair value gap as something as a potential trade that I was looking for to continue to the upside. And in conclusion, Power said rate hikes are not there. Another solution, but keeping the rate interest rate the same way. So already Immediately when I got that invasion fair value gap, it left another fair value gap. So I went long, stop loss was somewhere there. Already my target, I did speak to you about my target. And then we pushed, market gave us a 1:1. But immediately when we got that 1:1, I saw this 1 minute fair value gap here. When we rejected at that, remember already my stop loss was still there. Immediately we rejected at that 1 minute fair value gap. We came all the way higher and we left, we get invasion of this 1 minute fair value gap again here, and we close above, leaving this fair value gap, meaning that was a strong support. That fair value gap held strong. Immediately we closed above it. I moved my stop loss to break even, looking for a continuation to the upside. Unfortunately, that didn't happen. I didn't get that continuation to the upside. The only thing that happened was a rollover, took me on break even. So what's my conclusion on today's trade? I took two trades. I took two break evens. The first one, I took a break even, went straight to my take profit. And the other one is still dallying around. And in conclusion, what I'm going to say, and I think I'm really appreciative of how I managed my trade today. I'm very happy on the management of my trade and really how I weighed my option in terms of looking at fundamentals long term. But because now Paul was speaking, the way I managed my trade, I think I'm extremely happy with that. So, with that being said, ladies and gentlemen, it's been a good day. Though we lost a lot of money on the line, but we didn't lose anything. So sometimes you have to preserve your capital to be able to still trade tomorrow. You know what I always say in this show, preserve your capital. Try to preserve your capital. When you get a move, capitalize on the move that you got. And if it doesn't work out, didn't work out. So with everything that I just said in this conclusion, if you want to see any trade that I took, just jump back, start the life again, go through everything I've spoken about. I've interpreted what Powell was saying. I've interpreted the interest rate, even though I'm not going to speak much about it because I've already been on to trade for. But so saying that, guys, I truly appreciate you, all of you joining me. And if you'll be watching this later, do not forget to like and subscribe. Let's get to 100 subscribers for now. Let's get me improving, guys. My wish is to add more people into this live stream for us to trade together in the future. Anyone who wants to join me can send me an email and trade together, because this is a platform for all of us. I didn't create this for me, but for everyone, any trader who wants us to trade live together. And this is a show that I'm trying to build here. And as I always say, this is a Horrifumo trading show. If you are not with me every day, what are you doing, man? What are you doing, man? Other than that, come, let's learn together how to trade. Let's trade together. And other than that, if this comes to the end of the show, I got other things to do, man. Other than that, love you all. This is our Horrifumo Trading Show. My name is Priyankuna. Have a great day. I love you all. Peace.